We can get this afterwards. Good morning, everybody, and welcome to the Cooper Associates Wealth Management webinar, Markets Climb the Wall of Worry. Thank you for joining us this morning. We hope the webinar is going to give you some reassurance in this moment in time. I've just got a little bit of housekeeping. I am Megan Barton, the Head of Marketing at Cooper Associates Group, and I just want to run through a few things with you before we start the webinar. Just a bit of housekeeping. You all who are attending do not have your cameras on, so please don't worry. And we cannot hear your microphones either. So if you do talk to us, I'm really sorry, but we can't hear you. It's just our speakers and presenters who we can see and hear today. However, if you do need to get in touch with us, at the bottom of your screen on the bar at the bottom is a chat function. We do have access to that immediately. If you require any support, any help, or if you have any questions, please do type them into the chat function there. And my colleague Rory is here to assist you. We also wanted to let you know that we are recording today. We will be circulating the recording after the webinar, should you have any friends, relatives, or anybody that needs to watch it, or you want to watch it again, and we will be circulating it via email. We will also be sharing with you a feedback form, and we would love to hear your thoughts on the webinar today. So what are we covering today? We have a market update, the importance of long-term investing, confidence in the St. James's Place approach, and a pre-submitted Q&A at the end. And I'd like to introduce you to our wonderful speakers. We have our Managing Director of Cooper Associates Wealth Management, Simon Dawes. Hi, Simon.
Hello, everyone.
And we have Senior Financial Advisor, Mette Jensen. Hi, Mette.
Hello.
And it seems a really good time, actually, to pass over to Mette. So, Mette, if you could please share your slide and get us started. Thank you.
This now works. Hello, good morning, everybody. Very welcome. It's my pleasure to be speaking to you this morning about markets climbing the wall of worry. So the past couple of months have probably felt a bit like a whirlwind, and you're not alone in feeling that. We do understand that the political drama that's going on at the moment, the temptation is to react, and that's very real. And we understand that because the urge to act is very, very human. But we're going to urge you today to look at the data and not the story, because the story is all the headlines we're getting thrown at us day after day, moment after moment, and they can be very scary. But emotional reactions can lead to very poor investment outcomes. So staying the course, staying on your course of action you've already chosen is usually the investor's greatest advantage. Why? Because ultimately markets climb the wall of worry. What do I mean by that? Well, markets climbing the wall of worry refers to the financial market's tendency and ability to overcome negative factors and continue to rise. Because companies overcome, companies reinvest, they reinvent, and they keep growing, and markets keep climbing the wall of worries. So, are there things to be worried about? Well, you could argue that yes, there are. There are some very scary headlines. These are some of the headlights, if I can call it that, highlights we've had so far this year, and we're only a few months into the year. Now, I've been doing these presentations for quite a few years now, and I do one of these slides every year. So I thought it would be quite interesting for us just to have a little look at what the headlines were last year. What were we worried about last year? You'll see that Rachel Reeves makes it 2 years in a row, so well done her. But there were quite a few things we were worried about last year as well. We had very high levels of inflation. We were worried about interest rates. Were they going to come down? And actually, then I thought, well, let's go back 5 years. Let's go back to 2019. Now, back then, you'll see that America, China were at headlocks back then. That was Trump 1.0, his first term in office, and he was actually doing trade wars with China back then as well. He'd also just been impeached, and we had a small virus around for the first time that we'd first heard about called COVID. So the point of showing you these slides is that there's always something to worry about. And the risk is that we as investors, we listen to that story rather than the data. What if Labour wasn't in power? What if Donald Trump hadn't won the last election? Would that be making a difference? Sure, but not necessarily to all your investments, because it's not the color of the party that makes a difference to stock markets. You're not investing in prime ministers, presidents, or governments. And governments come and go, and stock markets tend to endure. They climb that wall of worry. So the orange blocks you can see here are years when we've had a Labour government, while the turquoise are years when we had a conservative government. Several Iraq wars, the dot-com boom and bust, the financial crisis of 2008, the China slowdown, COVID, Liz Truss, it's all on here, and yet markets over time continue to rise. And it's no difference going back and looking at the US. Going back almost 100 years, long-term investors have been rewarded irrespective of who's been in power. All that being said, markets have reacted very sharply to the Liberation Day tariffs announced by Donald Trump, which have caused significant volatility in major indices. And we do understand that the combination of unsettling headlines and that sudden turbulence in markets has raised concern amongst our clients. Simon.
So this here and what Mette has talked about, long-term investors are always rewarded for sitting tight despite short-term shocks. Now, this kind of just shows you what the markets have done. If you invested £100,000 in 1990 and continued to invest, it'd be worth £1.6 million today. And that's just if you invested in just generic world markets without any kind of active management whatsoever. Now, what does that mean? It means that despite all of these events that you can see here and that we've talked about, the markets have continued to climb the wall of worry. And to give you some context, if we went back 25 years ago and sat down with you and said, I think you should invest today, but in the next 3 years, we're going to have the dot-com bubble going to burst, and we're going to see market fall in the next 3 years. We're going to have invasion of Iraq. We're going to have a financial crash 8 years later. We're also going to have China-US tensions. We're going to have a global pandemic. Russia is going to invade Ukraine. We're going to have Hamas and Israel issues. And then also we're going to have these huge market volatility. The likelihood of that is encouraging you to invest in 2000 would be pretty poor. But actually, if you did, despite all of those things, markets have done incredibly well. And they continue to climb the wall of worry despite short-term volatility.
Oh, all right.
Sorry,
it's my fault. My thing has gone crazy. Sorry. Apologies. Oh my God, what's going on? There we go.
So this one.
So sorry, I don't know what's going on.
Apologies.
Sorry, it's me. Sorry.
So this slide here is a great slide to show you the short-term volatility and what markets actually did. So the red line is the long-term growth of markets since 1990, just similar to that last slide. So that's what markets actually did when you looked at the end of the year. How did they do? What the black lines show is the volatility index, if you like, every year and broken down on a monthly basis, actually. And of course, you can see some huge volatility. Now, to give you some context here, if we look at the 2008 period, which is the financial crash, which is kind of just to the right of the middle of the graph, you'll see there was a huge amount of volatility that year. In fact, the markets went down as much as 40% in 2008. However, they also grew over 40% the following year. Okay, and you'll see these huge spikes in short-term volatility. Pretty much every single year, the markets will have a huge range of deviation where they may be down on average, down 6% at one point and up 15% at one point, but actually where they end up settling at the end of the year, which is what is really important for compound growth, is the red line. So actually, if you stripped out all of the short-term volatility and all of that noise, actually, if you shut your eyes on the 1st of January and open them again on the 31st of December, which some investors do, and they wake up and think, well, actually, that was a really great year. I finished 7, 8, 9% up. Thank you very much. Those investors that actually watch the market every single day for 365 days of that year will tell a very, very different story, despite having exactly the same outcome.
Yeah, so it's the headlines that are creating the noise, and as Simon has just gone through there, the results over the long term tend to tell, the data tells quite a different story. But it's not pleasant to see the value of your investments falling rather than rising, and we understand that. But it's really important that we as investors remember that when the headlines are there, they're short-term noise, that they're the ones making us fearful. Now, our investment director, Joe Wiggins, puts it really well. He says markets are noisy, but successful investing is about focusing on what matters and ignoring what doesn't. So the politics can make us really nervous, but it's just short-term disturbance because companies adjust their supply chains. And we've heard only in the last week how Apple are already adjusting their very complex supply chain to make adjustments because of the tariffs, because the iPhone, for example, is made up of a global supply chain that are very much affected by these tariffs. But they have immediately taken steps to adjust the supply chain to try and they overcome, because that's what companies do. They keep overcoming, they keep reinventing and reinvesting, and therefore economies end up rebalancing and markets climb the wall of worry. Simon.
Something, look, of course, naturally we get the questions all of the time from clients, particularly in these periods of volatility, right? And we saw this going, we saw this again in 2022, okay, after the Liz Truss autumn statement. We saw this in 2020. We saw this back also in 2018 and 2015 with China's slowdown and the US and China kind of trade tariffs back in 2018 as well, and of course back in 2008. The question I've always got is should I now go into cash? And if so, when should I go back into the market? Well, my answer to that is never move into cash in these periods of volatility. That is definitely typically what retail investors do and often lose out. And this kind of represents this really well, is that it is about time in the markets, not timing of the markets. Okay, so this again, over the last 20 years, if you invested £100,000 in global markets and left it fully invested, despite all of those things that we've talked about that happened over the last 20 years, including what's happening right now, your investment would be worth just over £710,000. If we look at the yellow bar, if you missed just the best day in the markets every year for 20 years, so you missed the best 20 days in the markets over 20 years, your investment would only be worth £280,000 rather than £710,000. And again, obviously, the more days, the best days that you miss, the worst investment return over that 20-year period. What this really tells you is that you can't time the markets. You can't decide when you're going to put into cash. You can't decide when you're going to put money back into the market. It's impossible. And generally investors that do that tend to lose out over the long term. Those investors that are always rewarded are sit tight, continue to stay fully invested, of course, over the whole period, regardless of what's happening. And this shows you, hopefully, objectively, the kind of importance. You only got to miss some of the best 10 days. And if we look back over the last couple of days in the markets, you'll have seen, if you looked on kind of Wednesday and Thursday, some huge gains and rebounds in the markets of 8, 9, 10%. And of course, if you're sitting in cash at that point, when do you then decide to go back in? And those that stayed fully invested obviously benefited from all of that. So I thought I'd just share this with you. I just wanted to talk a little bit about kind of what are we doing with St. James's Place in terms of the investment strategy, and what have they done over the last 15 months to protect our clients. So St. James's Place from Q1 last year actually actively took the decision to lower its exposure to the US. You will have heard perhaps of the Magnificent Seven. So those are the likes of kind of Tesla, Google, Alphabet as it's known now, Mette, as you probably know better as Facebook, Amazon, Apple, Nvidia. Those top big 7 tech companies were really created what's called a concentration risk in the US, where those 7 companies made up almost 35% of the US growth last year. And bearing in mind, the US makes up 65% of global markets, by the way, and is the biggest economy in the world, and therefore the biggest stock market in the world. That created a really big concentration risk into pretty much 7 companies. So St. James's Place actively reduced its exposure to the US and increased some of that exposure to things like bonds, which are a lower risk asset class, more in the UK and more in Central Europe and in some of the developing markets in Asia. And as a result of doing that from Q1 last year and continuing that theme all the way through to this year as well, that has protected our clients hugely despite what's been going on. And what this shows you here is some of the big indexes. So the FTSE All Share, the Japanese markets, the MSCI World, so the world globe markets. So this is kind of year to date, world markets down about 10.3%. The NASDAQ, which is the US top 100 kind of mainly tech companies, down 10.35, and the S&P 500 down 13%. For our investors, St. James's Place, our exposure to the US has reduced significantly. The diversification of our portfolios and also the inclusion of bonds in some of those, and this reduced exposure to the US and more exposure to away from the US have protected our clients hugely, and even those in our 100% equity portfolios, which are the Adventurous and Polaris 4 there, have seen over half the impact that everyone else in the market has. And those taking a slightly lower risk approach and have more bonds in their portfolio as well, has almost seen a third of what everyone else has seen out there. So where you might see the headlines of, wow, what's going on out there, actually St. James's Place has protected you as investors hugely compared to the wider market, particularly for those that are DIY investors and others outside of St. James's Place. So that's made a massive, massive difference. And the next slide really just shows you generally the positioning of the asset allocation with St. James's Place. So where do they think they should be investing? Okay, and this is one of the questions on the Q&A, but they are underweight in the US. They felt that the US over the last 18 months has been expensive to invest in, and actually there are cheaper opportunities to invest in Central Europe, the UK, Japanese markets, and some of those emerging markets in Asia and South America. Really, that is where they see kind of some of the bigger value in stocks. That's where you might have seen the US 10, 15 years ago. Actually, we're seeing that in some really well-priced stocks in some of those countries and markets outside of the US. So underweight in the US, overweight slightly in some of those core 4 at the bottom, and mainly our bonds position has remained pretty neutral throughout all of this. Importantly, bonds have shown to create actually the asset class year to date that are all positive across all portfolios, and that it creates that's why diversification in your portfolio is really, really important, because it helps protect you in these times of volatility, and that's exactly what it's done.
Thank you, Simon. So we can't not speak in a bit more detail about Mr. Trump, because he clearly has set out to make America great again, and he's using tariffs as a way to control behavior in an effort to drive manufacturing back to the US. And we can't possibly sit here today and predict what he might do next. I don't think anyone can. He may not even know himself. But what we do know is that rather than him being a politician in the usual sense of the word, he is a businessman. He's a deal maker, and he's going to want to make deals. However, the severe market reactions we've seen in the last 10 days or so have forced him to pause all his global tariffs, apart from the basic 10% rate and some specific tariffs. We've still got tariffs here on cars, steel, with the exception of China, where he is clearly in a tit-for-tat war with them. He's levied 145% tariff on all goods from China imported into the US, and they have this morning again announced higher tariffs on US goods into China. So there is a tit-for-tat there. And the challenge with tariffs is understanding the magnitude and any retaliatory actions and what that might mean. And the fact that they're making announcements and then pausing them is causing uncertainty, and that's what markets really hate. Markets hate the uncertainty. Once everybody knows what's happening, they can go off as companies, make decisions, make plans, change, and that's what we're really looking for, is knowing where we are. Even if it is tariffs, as long as companies know what they have to deal with, they'll find ways around it, and they'll find ways to keep growing and building their companies. So political actions, they really matter. They shape policy, which can affect corporate earnings. They can affect taxes and regulations. And so the political backdrop today and these economic concerns are also underpinned by, fears about very high levels of global debt. So there are central banks who are walking at a tightrope. They're balancing rate hikes, and they need to keep supporting growth. So it is going to be a period of uncertainty, and we have to, to some degree, ride it out and let the markets settle down again and climb the wall of worry. And it's really important at times like this to remember and remind ourselves that market movements are actually quite normal. They're essential, in fact, for you as investors to get growth, because it's in the movements that there is opportunity. As Simon's just said, it's on those days when we get the big bounces that there really are opportunities for us as investors. That's where we see the growth. So we have talked about a lot of things that might seem not so positive, but actually there's a lot of reason for you as investors to be optimistic, despite everything we've said today. Because the landscape for investors is rife with opportunities, again, as Simon alluded to, particularly those investors who are prepared to take a long-term view. Because in non-US equity markets, particularly in the emerging regions alongside Europe and also here in the UK and Japan, these markets are offering compelling relative valuations. And as Simon also said, fixed income provides a very stabilizing role within diversified portfolios. So the dynamics have set the stage now for an investment approach that balances resilience with a readiness to capitalize on these new opportunities. So while political and economic factors are going to continue to influence markets in this year ahead, our focus here at SJP remains on balancing risk and reward through diversification, targeting valuation opportunities, and leveraging that active-passive spectrum to navigate the uncertainty with the aim of identifying potential growth areas for further growth. So the investment management team at St. James's Place are continuing to position the funds and portfolios for resilience and opportunity in this very quickly evolving market environment. So trying to look ahead, it is hard, but we are expecting the economic landscape to very much be shaped by fiscal policy, these evolving trade dynamics, and the divergent regional growth trajectories. So there has been a lot of focus on Donald Trump and his tariffs, but as long-term investors, we need to remind ourselves to look beyond this short-term noise. And perhaps rather than an emotional approach next time you see a headline, a more productive approach for you as an investor might be to ask yourself these questions. Have my goals and objectives changed? Has my risk tolerance changed? Has my time scales changed? Now, if the answer to any of these questions is yes, then you're very fortunate because you all have a financial advisor and we're here to help you. But if the answer to those questions is no, then you're very fortunate because the investment team is working on your behalf and they are on top of the situation and working extremely hard to get the best outcomes for everybody for long-term success. Because we always need to measure success of your investments over the time frame of your goals rather than over a day, a week, a quarter, or even a year. And uncertainty is nothing new. So these latest bouts of volatility, they just show how important it is to have a resilient portfolio and ensure that you're aware of any market concentration risks. Markets have faced so many challenges before. We've mentioned a few of them, and they've always recovered. But by staying diversified, disciplined, and focused very much on your long-term goals, we can help you build resilient portfolios, which will help you capture the opportunities ahead. But it is normal for you as investors to be tested by the volatility of these markets. It's very natural to feel very uneasy when markets swing. But the worst thing you can do is make emotional decisions. Because evidence really shows that when investors do that and they make emotional decisions, that's often when you make the largest mistake. So the next time you look at your investments or see the stock market has temporarily fallen, just remember this. While we as investors get fearful when the markets are falling, that's actually the time of the greatest opportunity and the time to be greedy, for lack of a better word. When the markets are flying and rising ever higher, that's actually the time to be fearful and the point of maximum financial risk. So what should you do now? What can you do? Well, for a start, don't panic. Keep calm and try to listen to the data and remember this data we've shown you today rather than listening to the story. And then consider actually whether now might be a good time to buy. Markets are down, which means investments you make now, they're going to be entering the market at a lower price point, if you will, at a discount. So when markets rise, which they inevitably will, you're going to benefit from that rise because you'll have bought in at the lower price. And right now, we're at the start of a new tax year. Equities are currently hugely discounted from where they were even a few weeks ago. So this might be a good time, if you can afford it, to top up your ISAs rather than waiting till next April. Do it now. Fill your pension. Make the investments because you'll be buying at a really good discount. So I think on that note, we're going to just hand back to Simon just for the sort of the takeaways from here, and then we'll move on to the Q&A session.
Thank you, Mette. Thank you, Mette. Look, hopefully the takeaways from this is there's nothing for anyone to worry about, and everyone here really, I know, has a medium to long-term view for their investments, and we're going to pick up some of the Q&A in a moment, which I'm going to share the questions with everyone, and we're going to go through them. But I think the takeaways here, look, market volatility is normal for all investors. Don't make any reactive decisions, because we've shown again and again that actually that does not help to achieve long-term capital growth, and that in fact does the opposite. Those points that Mette raised around just when you're looking at markets, just remember what your medium to long-term goal is, and that's really, really important. And again, it's really easy to get deep into the noise and all of the news stories and everything else, and what is going on out there. And actually, when we look at the data, in the short term, but also for the long term, and what markets have done historically, and what we believe they're likely to do over the medium to long term, we can strip out all of that noise for you. We've got some pre-submitted questions, so we're going to go on to those. I'm going to share those with everyone. Some of the questions I haven't included here because we've covered them off throughout all of this webinar with you. Importantly, your advisors will be notified if you've attended this and if you have asked any questions as well, so they'll know, and they'll be able to contact you as well and know that you've been attending this webinar, which they'll have a copy of as well. So just a few questions that I just wanted to just tick off. Are ISA pots affected the same differently to pension pots under the present circumstances? Are all affected the same way? So typically everything you hold with us, whether it's an ISA, a pension, investment bond, a unit trust, is all invested in the same portfolio. You may have different portfolios for your different tax wrappers, but everything will ultimately be invested and feel the same impact. The only difference is if you've got any cash holdings, of course, that are outside of your investments. Should consideration be given to changing the percentages of what the overall pots are invested in? Absolutely. The investment team are doing this for you on a daily basis. So St. James's Place investment management team are constantly, daily, reviewing markets, looking at where our asset allocation is, where are we invested, and making those decisions on your behalf to provide the better outcomes. And that's what we've seen with this reduction in the US exposure and increasing the likes of bonds and other core central economies like the UK, Central Europe, and Asia. So they are absolutely doing that on your behalf, and that's really important. Could 1 ounce gold reach 3,000 by the end of 2025? I don't know. Gold, historically is pretty volatile. It has obviously increased over the coming months, and typically people pour into gold in times of any uncertainty, but it is very much a very, very niche asset class. And actually, if you compare it to equity markets over the long term, equity markets have typically outperformed, but are a lot less risk tolerance. So I couldn't give you a definitive answer on that one, but an interesting point. Diversification is key, right? And that's the fundamental across all of our portfolios. And there will be exposure to those types of asset classes in some portfolios in some degree. Would your advice be different for retirement investment timelines of 3, 5, 7, and 10 years? So fundamentally, if you're looking to take a big lump out of an investment for a specific reason, have that conversation with your advisor, because it may be that we need to look at rebalancing your portfolio, considering some of our in-retirement portfolios that are designed to reduce against any what's called sequencing risk, of volatility in the market when you're drawing from them. So have those conversations with your advisors. But my takeaway would be your retirement pension should always be invested for decades. Even when you're going to start retiring and continue in your retirement, it will always be invested. And that's really, really important to consider. So have those conversations with your advisor about your time frame for retirement, because we might need to rebalance the portfolio slightly depending on your objectives and if they've changed. And again, ISJP able to mitigate market losses for clients, and now is a good time or risky time to invest more. I think Mette covered that off, and that actually, if you have got funds available, now is of course a good time to invest. But even if you don't, it's not about timing of the market, time in the market. As long as you've got a medium to long-term view for your investments, you're going to be in a good place. And as the biggest performer, is it best to stay with the US or move into other markets? Hopefully we've kind of covered that. We've reduced some of the exposure to the US, which is important to reduce that risk. It is still the biggest economy in the world. So of course you will have exposure to it, of course. But there are other opportunities in other markets. And we've made those strategic decisions with the help of the investment committee of St. James's Place. That's all the questions there covered. If there were any other ones that weren't covered there, your advisor will definitely be able to help you with those and will be notified if you have made any other specific questions that we've not answered today. But I think we've answered the majority of them. So thank you very much.
Thank you very much to our excellent speakers, Mette, Jensen and Simon Dawes. Just to remind you, you will be getting an email after this webinar to give you the recording and to also give you a feedback form. We would really appreciate any insight into whether you enjoyed it, found it useful, or had any further questions. Your advisors are always on hand if you would like to get in touch, or if you want to send us a message, we are very happy to put you in touch with them. And that concludes our webinar, The Markets Climb the Wall of Worry. So I just want to leave you with a quote from Chief Investment Officer Justin Onyewakusei, and he says, markets have faced countless challenges before and they've always recovered. So we hope that leaves you on a positive note. Thank you very much for joining us today. Apologies for running 2 minutes over, but we hope you have a brilliant rest of your day, and we hope you feel reassured about your investments and the future. Thank you very much. Goodbye.
Thank you, everyone.
Bye-bye.